Hello everyone, it's Professor Reiko here again, just walking us through our next lesson on the accounting cycle. This is our sixth video, and it starts our series on adjusting journal entries. All right, so adjusting journal entries is extremely important, and a lot of times students struggle in certain areas of this. So I broke this up into, I believe, 3 or 4 different videos. So we'll talk about deferrals in this one and what those are, and then we'll do accruals. We'll talk about depreciation, and then we'll do an example which puts them all together. All right, so we're at the adjusting journal entry phase. So if we look down here, when we talk about what is adjusting journal entries, all right, so notice they're at the end of an accounting period, and they ensure that all revenues and expenses are recorded in the correct accounting period. All right, so that's extremely important. All right, all revenues and expenses are recorded in the correct period, meaning if it's an expense or revenue of January, we want it recorded in January. So these adjusting journal entries allow us at the end of the month or quarter or year, whatever period we're looking at, it allows us to stop and grab all these expenses and revenues that need to be recorded in that time period. Okay. It also ensures that the balance sheet accounts reflect their current balance as of that point in time. So remember, your balance sheet is a reflection of your financial position at a point in time. Typically, when you look at financial statements, it's going to be the end of their accounting year. All right, so there's two main deferrals, two main categories, deferrals and accruals. And we'll also talk about depreciation because most textbooks will lump depreciation with these, especially with the deferral section, but I broke those out separately. All right, so what are deferrals? All right, so deferrals are adjustments for items that the business received or paid cash in advance. All right, so this is kind of the punchline here. So for these, we received or paid cash in advance. All right, which means that the revenue and expense is going to be recorded after the cash. All right, so cash is first. Sorry about that. Cash is first. And then our revenue or expense, depending on what, if we're looking at revenues or expenses, is deferred. All right, so that's the whole point of deferrals. The revenue or expense is deferred to the end of the period, and that's when we'll recognize it. All right, so there's 3 main types. We have prepaid expenses, we have unearned revenues, and we'll also talk about supplies, which is basically a prepaid expense. All right, so a prepaid expense is exactly what it sounds like. It is just an expense that is paid in advance. Right, so these are considered assets because they provide a future benefit to the company. All right, so they're assets, which means they have a normal debit balance. All right, so don't get these confused with expenses. Prepaid expenses just means it's something we paid in advance, and then what we're going to do is we're going to expense it as we use it up. So once again, remember, we're going to pay for it first. The cash comes first, and then we are going to defer the expense in this case to the end of the period. All right, so common examples are prepaid rent, prepaid insurance, things like that. All right, so let's just walk through a series of journal entries here. All right, on January 1st, a company pays $12,000 for the entire year's rent. All right, so that means on January 1, we are going to debit prepaid rent. All right, you might see this called prepaid rent expense. I typically leave the expense off just so we don't confuse ourselves thinking it's an actual expense account. All right, but either is fine. And we are crediting cash. All right, because remember, it says up here, use your keywords. We pay $12,000. All right, so we're going to debit $12,000 for prepaid rent, and we did pay the $12,000 in cash. All right, so remember, prepaid rent expense or prepaid rent is an asset. All right, because we now have the right to benefit from this building or warehouse or office space, whatever it is that we rented for the year. All right, now at the end of each month, the company is going to make the following entry to recognize that they used up 1 month's rent. Okay, so think about it. So we deferred the revenue or expense in this case. All right, so we deferred the revenue or expense. All right, so when we, at the end of each period, we are going to, so this will be January 31st, and at the end of February, the end of March, and so on. We are going to debit rent expense. So this is an actual expense that's going to go to our income statement, and we will credit prepaid rent. All right, so notice that we are crediting the asset account, which makes it go down. All right. And so remember, up here it was $12,000 for the entire year, which means it's $1,000 rent per month. So once again, we are using up or expensing it. I should say we're expensing it as we use it up. So 1 month has gone by, so let's expense 1 month. So remember, this 1,000 right here represents the rent for January. So we need that to be an expense in January. This journal entry ensures that that happens. All right, so once again, this goes to my income statement, and that will be an expense on my income statement. And then when you think about my prepaid rent account, if we just sketch out a T account over here. So we started, I'm going to leave all the zeros off. We started with 12,000. All right, we just credited 1,000, which means we have 11,000 left in the account. That represents the 11 other months that we still have to go through. All right. At the end of the year, the prepaid rent account will be zero because we'll have 12 credits of $1,000. And so we'll either start over or move out, whatever the case may be. All right. If we switch over now and do unearned revenue, all right, so unearned revenue is the exact opposite of prepaid expenses. All right, so notice prepaid expenses were assets. These are considered liabilities because we owe somebody something. So let's just switch gears now and say, instead of us renting office space, let's assume we're now the landlord. All right, so if somebody pays us for a whole year's rent in advance, then we now have the obligation to provide them with that office space or whatever they're renting for that entire year. So it's a liability to us. So it's not revenue when we get paid. It's revenue as we earn it over the life of the rent. Okay, other common examples would be unearned sales revenue. When somebody pays you in advance for something, you still have an obligation to perform the work. All right, so looking at this, we're just basically going to use the exact same example. The rent, 12,000 rent, but now we are the landlord. All right, so on January 1, we are now receiving the cash. Once again, these are deferrals, which means cash comes first, the expense or revenue comes last, and then we will call this unearned rent revenue. That's a little bit lengthy. You know, kind of understand how your teacher allows you to abbreviate. A lot of times when I'm doing this in my class, I'll just put URR for unearned rent revenue, and the students are fine to do that as well, but just make sure your teacher is cool with that. All right, so once again, make sure you understand this is a liability, not a revenue account. All right, and remember, liabilities and revenues are both credit balances, but this is a liability on my balance sheet. It means I have an obligation to provide them with this space. All right, so at the end of each month, once again, we'll recognize, oops, so that should be 131, sorry about that. At the end of each month, we'll recognize 1 month's rent. So now I am going to debit unearned revenue, and I'm just going to abbreviate that to make it easier, sorry, and that's for the $1,000. Once again, 1 month's worth of rent is 1,000. All right, but now we've actually earned that revenue. So this will be actual revenue, rent revenue, and this will go to my income statement. Just like the expense in the second journal entry on the previous page went to my income statement as well. All right, this right here reduces the liability account. Remember, liabilities are credit balances, so a debit would reduce that. So if we sketch out the T account, just like we did for the prepaid on the previous page, we started with 12,000. We just had this first debit of 1,000, which means we still have 11,000 of a liability, which represents the other 11 months that we still have to go through. All right, and at the end of the year, once again, it will zero out, and we can either renew our lease, our rent, or move out. All right, the last one is supplies. All right, supplies is essentially just another type of prepaid expense because we're going to debit the asset first and then expense it at the end of each period. It's just a little bit different. So we kind of separate in its own category. All right, so supplies are just an asset. Supplies are your paper clips, your printer toner, all that type stuff that's at the office. Those are your supplies. All right, so on January 1st. We buy a 500 worth of supplies. All right, so supplies are an asset, so we debit that, and we credit cash. All right, so notice in all these that we've done, cash is in the first journal entry. So with deferrals, cash comes first, revenue or expenses at the end of the period. Okay, at the end of the period, it says we have 350 worth of supplies left. All right, so what that is telling us, so if we just come over here and sketch out a T account for supplies, it's telling us, all right, so we started with 500, and that comes from right there. And then this right here tells me at the end of the period, I have 350 left, all right? So this 350 goes right there. What that means is we used up 150 worth of supply. So that's what we're going to expense. So my journal entry this period, I'm going to debit supplies expense for the 150 that we used up, and I'm going to credit supplies for the 150. Okay, so this credit to supplies is that credit right there. All right, so that's with supplies. So, it could tell you, be careful when you're doing problems on this, because it could say we used up 150, or it could give you like this example where it's how much is left. So make sure you kind of read your questions carefully and understand what number it's giving to you. With supplies, companies will do estimates of supplies on hand to determine the expense of the period. If you think about it, supplies are typically a smaller dollar value. That's why they're just going to kind of estimate what it is, because it's usually not a material amount. And it's also why, if you think about this journal entry right here, they're not going to, every time they, use a paper clip, they're not going to debit supplies expense and credit supplies for the value of that one paper clip, because, there's a cost benefit involved, and it just doesn't make any sense. So companies will estimate their supplies and then make this journal entry as an adjusting journal entry at the end of the period. All right, so this takes care of our deferrals. The next one we'll get into is accruals. It's still a different type of adjusting journal entry. So I hope you enjoyed this video. Please hit the like button if you do. Feel free to subscribe. I hope you're enjoying these videos, and we'll continue to put them up for you. And hope you tune in next time. Thanks.